March 10th, 2025 will be etched in the memories of investors as a day of reckoning. The stock market, already teetering on the edge, plunged into a dizzying free fall. This evoked chilling memories of past crashes, leaving many wondering if this was the beginning of a prolonged downturn. The catalyst? A potent cocktail of geopolitical anxieties, resurfacing trade war fears, and whispers of a looming recession. The markets, it seemed, had finally decided to confront the ghosts of uncertainties past. The day began with an unsettling quiet, a sense of foreboding hanging heavy in the air. As trading commenced, the initial tremors were subtle, almost imperceptible. However, as minutes turned into hours, the tremors morphed into a full-blown earthquake. The major indexes, barometers of the market's health, began their descent. The Dow Jones Industrial Average, a stalwart of American industry, shed hundreds of points. The S&P 500, a broader measure of the market's performance, followed suit, its decline even more pronounced. The technology-heavy Nasdaq Composite, often seen as a bellwether for the future of the economy, was hit particularly hard. The index, which had been flirting with record highs just a few months prior, found itself in a correction, down more than 10% from its recent peak. The suddenness and severity of the drop sent shockwaves through the financial world, leaving investors scrambling for answers and bracing for the worst. At the heart of this market meltdown lay the specter of renewed trade tensions, a ghost from the recent past that refused to be laid to rest. The financial markets, already jittery from a myriad of global uncertainties, found themselves once again at the mercy of geopolitical maneuvers. Former President Donald Trump, known for his unpredictable pronouncements and penchant for economic brinkmanship, had once again emerged as a central figure in the unfolding drama. His influence, though no longer from the Oval Office, still held significant sway over market sentiments. His recent comments, hinting at the possibility of a recession and reigniting fears of a trade war, sent shivers down the spines of investors worldwide. The mere suggestion of economic instability was enough to trigger a wave of sell-offs and heightened market volatility. Trump's trade policies, particularly his confrontational approach toward China, had been a source of considerable volatility during his presidency. The aggressive stance had led to a series of tit-for-tat tariffs that disrupted not just bilateral trade, but also global supply chains. The imposition of tariffs and the ensuing tit-for-tat retaliation had disrupted global supply chains, dampened business investment, and cast a long shadow over the global economic outlook. Companies found themselves grappling with increased costs and uncertainty, leading to a slowdown in investment and hiring. While a fragile truce had been reached, the underlying tensions had never truly dissipated. The trade truce was more of a temporary ceasefire than a resolution, with both sides remaining wary and prepared for further conflict. His recent pronouncements, therefore, served as a stark reminder of the potential for a rapid escalation in trade tensions, a prospect that sent investors fleeing for cover. The markets, already on edge, reacted swiftly to the renewed uncertainty. The timing of Trump's comments couldn't have been worse. They came at a moment when the global economy was already grappling with the fallout from the pandemic, supply chain disruptions, and inflationary pressures. They coincided with the implementation of fresh tariffs by both China and the United States, further fueling concerns about a full-blown trade war. The new tariffs threatened to exacerbate existing economic challenges, making recovery even more difficult. The specter of a trade war, with its potential to derail global growth, loomed large over the markets. Investors were acutely aware of the far-reaching implications such a conflict could have on global trade and economic stability. Investors, already grappling with economic uncertainties, were left to ponder the possibility of a repeat of 2018, a year marked by escalating trade tensions and a volatile stock market. The memories of that tumultuous period were still fresh, and the fear of history repeating itself was palpable. The Dow Jones Industrial Average, a bellwether of American industry and a closely watched gauge of investor sentiment, tumbled by over 2%, closing the day at 42,492.47. This sharp decline sent shockwaves through the financial community as investors grappled with the implications of such a significant drop. This represented a significant drop from its recent highs and underscored the depth of the market's anxieties. Analysts pointed to a combination of factors, including rising inflation, geopolitical tensions, and concerns over corporate earnings, as key drivers of the sell-off. The index, composed of 30 blue-chip companies representing a diverse range of sectors, painted a bleak picture of corporate America's prospects in the face of mounting economic headwinds. Executives in boardrooms across the country were left to reassess their strategies and brace for potential turbulence ahead. The S&P 500, a broader measure of the market's performance encompassing 500 large-cap companies, fared even worse, plummeting by over 3% to end the day at 5,695.31. This marked one of the steepest single-day declines in recent memory, further exacerbating fears of a prolonged downturn. This index, often seen as a barometer for the overall health of the U.S. economy, reflected the widespread pessimism that had gripped investors. The breadth of the decline suggested that no sector was immune to the prevailing negative sentiment. The decline was broad-based, with almost all sectors ending the day in negative territory, indicating a lack of safe havens in the market storm. From technology to consumer goods, every corner of the market felt the pressure. The tech-heavy Nasdaq Composite, home to many of the high-flying giants of the digital economy, suffered the most significant losses, plummeting by over 4% to close at 17,826.75. This dramatic fall highlighted the vulnerability of tech stocks, which had previously been seen as invincible. This sharp decline confirmed a correction, with the index now down more than 10% from its recent peak. Investors were left questioning whether the tech sector's meteoric rise had finally hit a ceiling. The rout in technology stocks, which had been leading the market's rally for years, signaled a potential shift in investor sentiment and raised concerns about the sustainability of their growth in the face of rising interest rates and a slowing economy. As the dust settled, market participants were left to ponder the future trajectory of the market and whether this was a temporary blip or the start of a more prolonged downturn. The technology sector, once considered an unstoppable force in the market, found itself at the epicenter of the sell-off. Investors who had long been bullish on tech stocks were suddenly faced with a harsh reality check as the market took a sharp downturn. The ripple effects were felt across the board, with some of the biggest names in the industry taking significant hits. Tesla, the electric vehicle maker led by Elon Musk, saw its shares plummet by a staggering 7%, marking its worst single-day performance in months. The drop was a stark reminder of the volatility that can come with high-growth stocks, especially in a sector as dynamic as electric vehicles. The company, already grappling with production delays and mounting competition, was hit by a double whammy of a bearish analyst report from UBS and the broader market downturn. Production issues have been a recurring theme for Tesla, and the added pressure from competitors only exacerbates the situation. UBS cut its delivery forecast and price target for Tesla, citing concerns about slowing demand in China, a key market for the electric vehicle maker. The Chinese market has been crucial for Tesla's growth strategy, and any signs of weakening demand there are particularly troubling for investors. Nvidia, a semiconductor giant that had been riding high on the wave of demand for its chips used in artificial intelligence and gaming, saw its shares tumble by over 5%. The decline came despite the company recently reporting strong earnings, highlighting the market's broader concerns. The company, despite reporting strong earnings recently, fell victim to the broader tech sell-off, as investors questioned whether its growth could be sustained in a slowing economy. The semiconductor industry is highly cyclical, and Nvidia's fortunes are closely tied to broader economic trends. Meta, the parent company of Facebook, Instagram, and WhatsApp, also took a hit, with its shares falling by over 4%. The social media giant has been under intense scrutiny for its business practices and the way it handles user data. The social media giant, already facing scrutiny over its handling of user data and the spread of misinformation, found itself grappling with a slowdown in advertising revenue growth, further weighing on its stock price. Advertising revenue is the lifeblood of Meta's business model, and any slowdown in this area is a significant concern for investors. Amazon, the e-commerce behemoth, was not spared either. The company's shares slid by over 3%, reflecting concerns about slowing growth in its core retail business and the impact of rising inflation on consumer spending. Its shares slid by over 3%, reflecting concerns about slowing growth in its core retail business and the impact of rising inflation on consumer spending. Inflation has been a growing concern for many sectors, but for a company like Amazon, which relies heavily on consumer spending, the impact can be particularly pronounced. The company, which had become synonymous with online shopping and cloud computing, found itself facing a confluence of headwinds, ranging from increased competition to regulatory scrutiny, leading investors to question its ability to maintain its dominance in the years to come. The challenges ahead for Amazon are multifaceted, and how the company navigates these will be closely watched by the market.